Hey, welcome back, traders. It's March 15th, 2024. I'm recording this about 1:30 Eastern Standard Time on Friday. It's time for a general market update. Let's get into the markets here. Just our typical disclaimer, I'm an individual growth stock investor. Before we jump in, I know I mentioned this last week, but some of you I know watch the video at either double speed or sometimes you sign off early. So I'm moving this announcement. I am launching a website towards the end of May, early June. If you're interested in being on the list, so as I get closer to launching, please send me an email to support@rainkinginsights.com. I'll get you on a list as we get closer. If I have an early bird special, I want you to get the email. So with that done, let's launch into the markets here. So the agenda is to get into the indices and the market internals, as we always do. And then I've put together a segment called Persistent Trends and Pullback Opportunities, and then we'll wrap up. So let's launch into the indices. This is the Nasdaq composite. This is a daily chart. And last Friday, we had the expectation breaker where we tried to move to new highs, but reversed very, very hard. The index has been basically going sideways for the past 2 weeks, been chop. This black line is the all-time highs for the Nasdaq, so it's really paused here, and it's come back down. And as of this recording, we had just broken through the 20-day. So even though it's going sideways at the index level, there's still more distribution under the surface. There are really deterioration in the new highs and new lows. If we look at the new highs, new lows, you can see here that in this 2-week period of going sideways, the number of new highs has been gradually declining, while the number of new lows is increasing. We actually have over 50 new lows, which is really not what you want to see in a bull market. And if you look at this line, the amount of new lows, this is the largest number of, this should say new lows instead of new highs, new lows that we've had since the beginning of this rally, really back in early November. So there's definitely signs here that things are pausing. We have to see how the deterioration goes. So here's the S&P 500. We talked about that 5,000 level. Didn't really stop the train. The S&P continued through the 5,000 level and has been continuing to be the stronger of the indexes. The question is, if we get a pullback, will the 5,000 level hold as support? Also, it coincides right about where the 50-day moving average will be very shortly in red here. So those are going to be a confluence of two levels that might provide the type of support we need in the S&P. That would be about a 4.3% decline from the peak, which would be completely normal given the extended trend that we're in. You'll notice that on the new highs, new lows, things are holding up much better on the broader index. You can see that we don't have really accelerating new lows, and we still have decent number of new highs. There's a lot of rotation going on under the surface. Some of the stronger sectors of the S&P are the industrials, the XLI, and we're going to look at the XLE and XOP in just a moment. But the S&P is definitely the stronger. Tech has been correcting. So if I took the XLE, the energy sector, and I divided it by SPY, just to see which one is outperforming, you can see since the beginning of February, the energy index is starting to outperform the S&P as a whole. Same thing with XOP. XOP is the oil exploration sector. And you can see here again, since early February, and that's right when tech started to correct, a small uptrend has started in the oil explorers. And you can see this looks fairly steady. It's not wide, big swings like we saw back here. So it's just something to keep an eye on, the sector rotations that are happening. Now, speaking of sectors and some of the analysis of the market, this is XLY, which is consumer discretionary. And I divided that by the S&P to see which one is outperforming. And on a relative basis, this discretionary, consumer discretionary, has been underperforming the S&P all of 2024. Since this peak, it's been pretty much in a downtrend. And you'll notice that we're almost at new lows in the consumer discretionary if you go all the way back Now, it's possible we might get a little undercut and rally here, get some support, but it's not a great picture right now for what's happening possibly in the economy under the surface. Now, if you take the Qs, which have been the strongest tech measure, even they have been underperforming the S&P. When you divide the two, you can see the line is headed down. And since early in 2024, the Qs have been underperforming the S&P. So there really has been a tech correction going on for the past 4 to 5 weeks. It just hasn't shown up so much in the headline Nasdaq Composite Index, but it's certainly been going on. I know as traders that play in the tech space, you've been experiencing choppy markets, stop outs, and really some action that's really not making a lot of progress. Now, I always want to keep my eye on the big leader, and NVIDIA is the big leader of the market. And so we've talked about this chart before, but I thought it'd be a good idea to do an update because I think there's a lot of interesting things going on in the chart. We had this real strong push with multiple gaps, kind of an exhaustion gap, went to the peak of about 974, which is right in line with the idea that I had mentioned about the 1,000 level being possibly a pause in NVIDIA. And we also mentioned that the 2 trillion valuation somewhere in the 820 range probably could act as support. We might get some bounce between the two. So what's been going on? We had this really, really high volume day in NVIDIA, got a high volume close. And so I've just marked that horizontally on the chart. I do use that in some of my analysis, and I'll go into this deeper when Rain King Insights launches. But what's going on is, it's possible that NVIDIA comes back down into the purple line here, which is the 20 EMA. And the 20 EMA and this 2 trillion valuation are pretty much lined up. So that could be support if the market pulls down and we get some bounce there. That's possible. Also, you'll notice that there's a real pennant that is forming, a little technical pattern here where it's higher lows and lower highs, and it's kind of coiling up in this range here. We don't know if it's going to break lower or break higher, but usually as this gets tighter, it's going to go one way or the other. So it's possible we get some support down here at the 2 trillion or the 20-day, and we basically build a base. That would be healthy for NVIDIA, as well as it would help to stabilize probably the overall tech sector. Now, it's also possible that we come back down to the 2 trillion 20 EMA level. We try to rally, and we rally right into this high volume close, which acts as resistance, which is possible, which means we might roll back down. And in that case, the red line here, the 50-day moving average, may come in play to be a support level for NVIDIA. So a lot of interesting things going on in the chart. It's one to keep an eye on. So let's move into persistent trend and pullback opportunities. So you've probably taken some profits along the way, and you probably have pushed out of some positions as well as they've corrected, unless you're holding a position trade to try and capture a big move. So it's interesting when you raise all this cash, you have a dilemma. You're saying, geez, I want to put this cash back to work in the market, but you don't want to be too quick to redeploy the cash if the environment is not right. You have to exercise some patience. And the fine line is, if the market only corrects briefly and really starts to rally again, you don't want to be too slow to get your exposure back on, because then you're going to be left behind. So it's a very, very fine line there after you've taken some profits and raised cash levels. Don't feel like you got to do something immediately. You need to be patient and make sure the market environment is correct. So when we talk about pullbacks, and I'm talking about pullbacks as a position trader time frame. So we could have pullbacks to the 20-day moving average, really short-term pullbacks, or typically we'll get pullbacks down to the 50-day, which is more of an intermediate term pullback. And the 10-week moving average line can typically act as support. So let's look at this a little bit closer. When you're raised some cash and you've got more cash in your account looking to redeploy, We're constantly thinking about where can I put some pilot positions on, test the waters of the market. You're kind of like a fisherman that throws multiple lines into the ocean, and you don't know if you're going to catch a fish or the fish is going to nibble at your bait, eat it, and then you're going to be left with nothing. There's going to be probably some samples that you take, some pilots that get stopped out. That's part of the game because you're just trying to make sure that you don't get caught flat-footed if the market really continues higher. So take some nibbles, but keep it small, and let's wait for the environment to improve. Now, when I'm looking at pullbacks, the qualifier that I look at is I look at something called persistent trend on the way up. And so I'm going to get into this a little bit more, but I'm looking to see 15 to 20 bars on the chart that are going up. I look for small or little overlap between the bars, and I'm looking for kind of a consistent line of trend, of ascent. So we're going to look at some charts, and I'll explain what all this really means. So, we're in a secular bull uptrend. We've been running since November, and we're in an uptrend. So we are in an uptrend until we aren't, until we see signs of a long-term top, which we don't really see that today. So when we talk about individual stocks, we talk about stocks that pull back in an uptrend. So if I've got stock A here and it pulls back to the 20-day, which I've shown in black, there's typical pullbacks to the 20-day. They bounce, get support. Leading stocks typically will get some support around the 20-day. Now, other individual stocks have different character. This purple line represents a stock that's in an uptrend, but it may come all the way back down and tag the 50 SMA, simple moving average. So it's a little deeper correction, but it can still act as support for a position trade, depending on your average cost. So let's look at some examples of the qualifiers that I mentioned. So persistent trends. Let's look at some examples. This is Eagle Materials, current chart. This is a weekly chart. So you can see as it came off the bottom here, that's a really powerful move. 8 weeks up in a row, very strong. And you can see then it went sideways for about 4 weeks, 5 weeks. Very tight action, tight closes, tight digestion of a very big move. And then it broke out of there. And you can see another 9 weeks up in a row. Incredibly strong action to see anything more than 5 weeks up in a row. So if we break this down in a different way, if we look at a line chart, this is the same chart, weekly chart, but it's a line chart, and I've used the dots here to represent the closing price. So weekly closing prices. And the point I'm trying to make is, in this uptrend that we saw here, if you look at these dots, and I just drew a red line through them all, you can almost see that the closes are rising at a consistent pace. You can see the line almost touches all the dots. That's a very consistent uptrend. And you can see when it went sideways, very, very tight closes, held all the gains. And then when it launched again, you can see the line I've drawn here almost intersects very closely most of these dots. That's what we mean by a persistent uptrend. Now, I mentioned about the lap in a bar. So if I took a couple of the bars from this weekly chart and I blow them up, you can see here this bar right here off the bottom, and I'm comparing it to the bar right next to it. And you can see here that below the bar here and the top of the previous bar, there's very little overlap. And I did that for a couple here. Very little overlap, very little overlap. Generally, if the lap is 30% or less, I consider that to be really good action. The bars are typically going to overlap to some degree, but 30% or less means there's just a lot of persistent buying. The stock doesn't come back and retrace too much. So that's a general guide I use on these, trying to identify persistent uptrends. So let's look at another example. This is Wingstop. This is a good chart to look at. So I put this as a bar chart with closing prices. And, back in the follow through day in early November, this was in a large cup pattern, and I've drawn the pivot. The pivot was right here, the breakout point. And then you can look right here. Look at this trend right here. And I've drawn a line kind of right through the middle of it. And you can see there's 28 bars. The stock makes a 16% advance, And there's overlapping bars in here. So it's a little bit still a lot of overlap. It's not the best. And you can see the angle is probably in the 30-degree range. Then the stock corrected, and then we got another push higher. The second push higher, you can notice here that it was 11 bars, 16% gain. Not much overlap in the bars, meaning the trend is probably getting stronger. There's more demand coming in for the stock. And then you'll notice here, even the last push higher, which really got it into an overextended mode here, you can see they are wide range bars. But if you look at the closing prices with this line that I've drawn through, it touches almost all the closes. So even though we're rising at a much steeper rate, it's a very persistent trend, 13 bars, 23% gain. And when you get into the bars, there's not that much overlap. So that's really, really positive. So that just tells me that's a very strong stock. Now it's clearly extended. You can see here that it came back down to the 20-day. We don't know if the 20-day is going to hold. It might come back all the way down to the 50-day given this extension. But again, I'm trying to emphasize, trying to identify on charts persistent trends, which correlates with real strong demand from institutions. Here's one more. This is Uber, another very strong stock. Here's where it came out of its base, had a real nice push higher as it came off the bottom, 15 bars and moved 31%. You can see that a lot of the closes are right through this line, showing some persistent move. And you can see here it came back to the 50-day moving average and got support. And then the next move was a little choppier. You can see how there's more pullbacks in here, and it doesn't touch all the bars. So it's a little less strong, but it was a good move, 22%. And then you've noticed that it had this gap up shortly after earnings. And what is the stock doing now? If you really look at the closes, look at all these closes that are in this yellow box. Basically, between the 77.50 and the 79.50 range, there's a lot of closes, and it's digesting. So again, at the 20-day currently, but given the market conditions, it would not be surprising at all for it to come gradually back down to the 50-day. If we look at the weekly chart of Uber here, over on the left, we can see here we had a pullback to the 10-week moving average. And like I said, we could definitely get a pullback down to the 10-week again. And as a good rule of thumb, if you have a stock that's a canceling stock and it's showing you institutional quality characteristics, usually the first two pullbacks to the 10-week moving average are viable. So this would be the second one for Uber. So this potentially is a viable pullback depending on how it unfolds, but it's certainly on my watch list. And the last one we'll look at, this is Spotify. Again, Spotify broke out back in November, and you can see these run-ups. Look at this run-up here, 23 bars, 15%. Look at all the closes that go right. That's institutional demand when you start seeing all that steady demand coming in for the stock. Again, it pulled back, came back down to the 20, and it started to launch again. Again, a nice move, 21 bars, 16%, and it touches a lot of those bars. And again, the last move is a little bit wider in character, 16 bars, 13%, and now we've pulled back to basically the 20-day moving average. But again, this is a stock I'm interested in because it's showing persistent strength, persistent trend. And on the weekly chart, it also looks strong. You got 5 weeks up in a row as it came out of the base, and we got 9 weeks up in a row after this small pullback. This is a very strong move. And again, this would be a situation where Spotify might pull back to the 10-week moving average. It would be its first trip to the 10-week moving average. Now you might say, John, this looks like a 10-week moving average pullback, but I don't consider that to be a pullback to the 10-week because it's so close to the breakout point. That's really a pullback to the pivot, testing the breakout. So really this stock, in my mind, this is the first trip to the 10-week. So that's a little bit about persistent trends and how I'm looking at it to try and create a watch list so I'm ready if the market corrects and then takes off again. So I just put together my 10-week pullback list. Here's some symbols that I think are exhibiting some of these persistent trends, characteristics. So these might be some names that you want to look at deeper to see if they meet your qualifications and qualifiers. But these are some things I've got on my watch list. So let's wrap up. So the Nasdaq really hasn't made any progress in the last 2 weeks, and we are seeing more distribution and really some more deterioration in some of the leading stocks. It's getting choppy, not great action. The indexes are showing in the headline looks okay, but we all know and can feel it. There's been some gap downs, there's been some stalling action, and it's just been chop in most stocks. So it hasn't been good for tech investors the last 4 to 5 weeks. Power trend is still in place, maybe under some pressure, but it's still in place. Now, the 20-day, we might get a close below that today. We'll have to see how it plays out. It's not a disaster, but it just gives us another clue that maybe things are going to pull in deeper, possibly down to the 50-day. New highs and new lows, we mentioned. 50 new lows is not what we want to see. They are increasing. Even though the index is holding up, there's deterioration in the Nasdaq under the surface. So that's not a good sign. Some leading stocks are rolling over. But the good news is, and we talked about this last week, there's really a new crop of emerging leaders. And I think on my action of the leaders, I listed 10 to 15 stocks that had gap ups and were acting strong. So we want to monitor those closely. Now, the Mag 7 has probably been reduced to the Mag 4. Some of the real underperformers, Apple and Tesla, they're really not doing anything. There's a lot of rotation out of those names. Some of it's going into Mag 7 names like NVIDIA, but in general, the Qs look like they're actually, the money is moving away from them, other than probably NVIDIA and Microsoft, which also had a breakout this week. So again, another sign of deterioration when the Qs, which are the leading index, are starting to show some wear. Exposure levels, I think it should be down to about 20 to 35%. I think the market is pretty vulnerable to a pullback. And the 20 to 35% that you do have exposure, I think it's pretty important that you have some cushion and really evaluate if you could hold through a pullback down to the 50-day. If you can't, you might want to take some gains here to cushion and prevent a deep drawdown. We don't want to take deep drawdowns after we've made good progress. Definitely, I believe, the correction has been going on for 4 or 5 weeks in tech under the surface. So I think it's a matter of time before the Nasdaq just follows suit and probably pulls back somewhere in the 5 to 8% range, which would actually be healthy in the context of an uptrend. So we just have to be prepared to cushion for the blow. And then we also have to be ready in case things turn around. We don't want to be caught flat-footed. So our quote of the week by Confucius. By 3 methods, we learn wisdom. First, by reflection, which is the noblest. Second, by imitation, which is the easiest. And third, by experience, which is the bitterest. You only get good at something by experiencing it. And we all know that in trading, you can read a book, but that isn't going to help you be a great trader. You eventually have to put on positions with real money and get experience, make mistakes, and then study those mistakes to improve your investing results. That's going to be pretty much the mission of Rain King Insights, is to try and educate investors, help people improve incrementally to get better results. That's the general market update for Friday, March 15th. We look forward to seeing everybody next Friday, and have a great weekend, everyone.